If you own a rental property and you have never ordered a depreciation schedule, there is a very good chance you're overpaying tax every single year. CanStar's modelling shows missing a schedule on a typical new build unit can mean walking away from around $100,000 of legal deductions over the first 10 years alone. Today, I will walk you through exactly how to fix that, step by step. Here is why this matters so much. According to CanStar, roughly 98% of a new residential build's construction cost is depreciable for tax purposes. That means a $400,000 build can support around $392,000 in total deductions over its life. This is not a loophole. It is the ATO explicitly letting you claim the decline in value of your building and its fixtures. Before we touch any tools, understand what is actually at risk. The ATO lets you claim two things each year: capital works, which is the building itself, and depreciating assets, which are fixtures and fittings like carpets, appliances, and air conditioning. CanStar found a brand new property can generate around $16,000 in deductions in year one and close to $100,000 over the first decade. Every year you go without a schedule, that deduction is simply gone. Let me make the stakes concrete in dollars. On a typical property built between 2000 and 2020, not having a schedule means losing roughly $65,000 in deductions over 10 years, according to CanStar. At a 37% marginal tax rate, that is around $24,000 of extra tax you hand to the ATO over the decade. That is real money that could have gone into extra loan repayments or another deposit. Your first concrete move is to engage a quantity surveyor to prepare an ATO-compliant tax depreciation schedule. Use a recognised specialist firm such as BMT, Washington Brown or DuoTax, whose reports explicitly reference ATO rules and effective lives. Request a quote, then give them the property address, settlement date, construction date, purchase price, and any renovation history. The fee itself is generally tax deductible, so this is rarely money out of pocket in the long run. Once engaged, the surveyor will inspect the property, and they can liaise directly with your property manager or tenant so you do not have to coordinate access yourself. They identify every eligible capital works item and depreciating asset, which is the part most DIY estimates miss completely. According to BMT's service description, you can often receive the finished schedule within about 7 days of supplying all the information, and that single report covers up to 40 years of deductions. Here is what good looks like so you can sanity check your report. For a brand new property, CanStar's modelling suggests first-year deductions in the five-figure range, around $16,000. For a property built between 2000 and 2020, total annual deductions of roughly $6,500 in the early years are typical. If your schedule comes back well below these benchmarks, ask the surveyor why. Second move, do not just accept the default. Confirm with your accountant which depreciation method is being used. Prime cost gives a uniform deduction each year, while diminishing value front loads bigger deductions early. Under ATO rules, assets costing $300 or less can usually be claimed immediately, and assets under $1,000 can be pooled in a low-value pool for accelerated claims. If your priority is cash flow now, diminishing value and pooling will show up as larger early year amounts on your schedule. While you have your accountant's attention, review the schedule against the ATO's published effective life tables and depreciation formulas. The ATO requires you to keep records showing how you worked out the decline in value. So this step protects you if you are ever audited. Effective life determinations are periodically updated, so make sure your schedule uses the current rulings, especially before any major renovation or asset replacement. Third move, and this is where people get real refunds back. If you have owned the property for years without a schedule, you can backdate the missed depreciation. Take your completed schedule to your accountant, identify every year where you underclaimed, and lodge amended returns through ATO online via MyGov or through your tax agent. CanStar's guidance confirms the process: quantity surveyor first, then accountant to amend the prior returns. The payoff from backdating can be significant. For a typical property built between 2000 and 2020, CanStar estimates properly backdated claims over 10 years can approach $65,000 in extra deductions. If you previously claimed very little. For a brand new property, that figure climbs toward $100,000 over the first decade. Monitor the resulting refunds and redirect them into extra repayments or super. Your final ongoing move is maintenance. A tax depreciation schedule does not expire. It can cover up to 40 years of deductions, but it must be updated whenever you add new assets, renovate, or replace fittings like a hot water system or air conditioner. Each time you make a major change, ask your surveyor to refresh the schedule against current effective life rulings so you keep claiming every dollar you are entitled to. The biggest mistake I see is the belief that depreciation only matters for brand new properties. That is simply wrong. CanStar's modelling shows properties built between 1987 and 2000 can still yield around $4,000 per year, or roughly $40,000 over the first 10 years. The ATO allows capital works and asset deductions on residential rentals regardless of age, so do not write off your schedule just because the building is older. The second common mistake is relying on a rough DIY estimate from your accountant. Accountants are not qualified to value capital works on the building. Only a quantity surveyor can do that legally. So if your return only shows a few $1,000s of obvious appliance depreciation, you're likely missing the much larger capital works deduction. That gap can easily be several $1,000s a year, which is the entire reason a professional schedule pays for itself many times over. Let me run the whole plan back quickly. 1. Order a professional schedule from a quantity surveyor. 2. Confirm whether prime cost or diminishing value suits your cash flow. 3. Verify the effective lives against the ATO tables. 4. Backdate any missed years through amended returns. And 5. Update the schedule whenever you renovate. Do those 5 things and you stop paying tax on income you never needed to. If this saved you from leaving tens of thousands on the table, hit subscribe so you do not miss the next breakdown. Next up, I'm walking through negative gearing and how depreciation supercharges it at tax time. This has been general information only and not financial advice, so check your own numbers with a registered tax agent before you act.